Hello class, my name is Ingram Mitchum. This is Finance 652. The instructor is Dr. Chatterjee in the Jesse H. Jones School of Business. My two companies are United Healthcare versus Cigna. So let's talk about the background for both companies. Let's start with United Healthcare. It was formed in 1977 by Dr. Paul Ella Wood and Richard Burke, went public in 1984, period of rapid growth after 1998, acquired Empress Van Marka, provides an access to 1.2 million physicians. So let's take a look at Cigna Corporation. It was formed in 1982, merger of INA Corporation, proposed primarily through acquisition, fifth largest healthcare industry company in the U.S., and partnered with overseas companies expanding profit and growth. So now let's take a look at my Excel calculations. Liquidity ratios. Liquidity is the measure of a company's ability to pay off short-term obligations through assets and can be quickly converted into cash. Now, the two wide used liquidity measures are the current ratio and the quick ratio, which is in Chapter 3. The liquidity ratios for the United Healthcare Group for the 5-year period in 2013 to 2017 is clearly shown in my Excel file. So let's look at United Healthcare liquidity ratios. Current ratio, current assets, current liabilities. So in 2013, United Healthcare was 0.73%. In 14, it went up to 0.77. In 2015, it went back down to 0.74. And 2016, it was 0.69, and 17, 0.73. Now, the quick ratio is not applicable because why? There are no inventories. So the current ratio in the 5 years are well below 1.0, showing that the company has some liquidity issues. The quick ratio is not applicable since the United Healthcare Group does not have any inventories in its current assets. So let's look at the asset management ratios. Asset management ratios are a measure of the company's effectiveness in managing its fixed assets and working capital. Now, the ratios generally are the inventory, turnover ratios, and the collection period of outstanding, but the fixed assets turnover ratios and the total asset turnover ratios, which again is found in Chapter 3. The inventory turnover ratio does not apply to the United Healthcare since the company does not work with inventories. The other three ratios are clearly shown in my Excel file. So let's look at United Healthcare asset management ratios. In 2013, they were up by 21.0, and in 2014, they went up a little bit more to 27.3. But in 2015, they moved a little higher to 31.0. 2016, they dropped a little bit to 30.9. 2017, they were at 28.7. So the fixed asset turnover ratio, you can tell in 2013, they did pretty good, 30.5. But in 2017, they dropped real low to 28.7. So the total assets turnover ratio, they started in 13 at 1.5, and in 2017, they dropped down to 1.4. The company collects its outstanding in about 30 days, which is good since it's dealing with a very large number of retail customers. Now, the fixed asset turnover ratio relates to the sales revenue with the company's investment in fixed assets. Now, the ratio is constant at around 30, showing that the healthcare insurance is not an asset industry. Property, plant, and equipment makes up about 7% of the total non-current as shown in my balance sheet. In contrast, the total asset turnover ratio is around 1.5. Now, the company uses large amounts of non-physical assets in its operation. Goodwill and intangible assets make up close to about 60% of total non-current assets, and the company also has substantial long-term investments. Now, there are no absolute measures of these ratios, but comparisons are made with other companies in the same industry to elevate management effectively. So let's look at debt management ratios. Longer and larger use for debt financing and financial leverage can result in lower cost of capital for the company since interest payments are tax deductible. Larger debt, however, involves larger risk, since failure to pay interest or repay principal may result in legal action by lenders, forcing a company into bankruptcy, which is also found in Chapter 3. The debt management ratios for United Healthcare Group are also listed here in my Excel sheet. Debt management ratios, which is total liabilities divided by total assets. So in 2013, United Healthcare were at 0.6, and in 2017, they ended up at 0.6. The debt to equity ratio, they started in 2013 at 1.5 and ended up at 1.7 in 2017. So their long-term debt to equity was 0.4, and in 2017 it was 0.6. Times interest earned ratio, they were at 12.6, and 2017, 11.8. So the long-term debt to equity ratio is low at 0.6 in the recent 2 years, showing low financial leverage. And the consequences of this is reduced risk. Now, the cost of capital of the company could be higher than other companies in some industry using greater financial leverage. Now, the low debt to equity ratio also reflects in the debt ratio and the debt to equity ratios. The low debt is also reflected in the EBIT, being 11 times or more than the interest expense in each of the 5 years. So now let's look at Cigna. Liquidity ratios from 2013 to 2017. Current ratio, 2013 was 2.24, 2017 was 1.67. Now the current assets and quick ratio is non-applicable. Assets, inventories, current liabilities, no inventories. So Cigna has exceptionally high liquidity with the ratio significantly higher than needed. Now the reason is high proportion of receivables in the current assets. The quick ratio is not applicable as Cigna does not have any inventories. Asset management ratios. The days sales outstanding in high at 82.7 days in 2017 and has been higher in the early years. Now the long collection period carries the inherent risk of defaults. So the asset management ratios in 2013 was 104.7. In 2017, which I stated earlier, it ended in 82.7. Fixed assets turnover is 22.1, and 2017 it was 26.6. Total assets turnover is 0.6, And in 2017, it ended up at 0.7. So the fixed asset turnover ratio is very good, as healthcare insurance companies have low investments in property, plant, and equipment. Cigna total assets are, however, high, resulting in the total asset turnover ratio being low. But there are subsequently long-term investments and significant goodwill and other intangible assets of the balance sheet. So the debt management ratio. The debt management ratio for Cigna Corporation is in 2013 0.8 and 2017 0.8. Now the debt to equity ratio is 4.1 and 2017 is 3.5. Long-term debt to equity is 0.5 and 2017 is 0.3. So the ratio long-term debt shareholders equity is not applicable. Times interest earned ratio EBIT not applicable, and there are no interest expense. So the long-term debt to equity ratio for Cigna in 2017 was only 0.3. and 0.4 in the next 2 years. So the income statement does not show any interest expense through the balance sheet, which shows around $5 million of long-term debt in which of 5 years. So this could be possibly due to the interest on debt being subsidized. In the interest from long-term investments, the debt ratio and debt to equity ratios also reflect low debt in Cigna balance sheet. So let's look at analysis of ratios. The dew point ratio of two companies are shown. So the dew point shows in 2013, United Healthcare was 17.0, and in 2017, it was 20.8. So Cigna is 13.8, and 2017, 16.2. So both companies have a good return on equity. Now the United Healthcare return has been consistent in the past 4 years of the increase in 2017 due to the lowering of tax rate. Now the Cigna figure shows fluctuation returns with the 2017 increase due to major share repurchase program. So the accounting measures reflect the significant comparison under accounting measures is the return on capital employed, ROC. So the return on capital employed for United Healthcare in 2013 is 14.5%, 2017 is 13.8%, but Cigna is 5.2% in 2013 and 7.3% in 2017, which United Healthcare has the highest return on capital. United Healthcare is consistent, even higher returns on the capital because the ratio is consistent with the profitability to the asset ratio discussed earlier. Cost of capital. Accounting measurements. Various accounting measures of type are also used for analyzing trends over a period for loan comparing companies. United Healthcare has maintained consistent year-to-year improvement over the 5-year period. Now, the weighted average cost of capital, WACC, for the economic values added has been taken from the Focus.com website, United Healthcare WACC. Now, the overall picture that emerges from the overall ratio of each company that is showing growth and improvements in profitability and other performances measures over the past 5 years. So the net profit merger for Cigna has fluctuated between 4.6 and 5.5% in the past 3 years. Now, the operating profit margin also shows fluctuation. The gross profit margin is the same as operating profit margin since there are no interest costs shown in the income statement. Now, Cigna does have long-term debt also shown in the balance sheet. So the interest costs are preferably offset against interest earning from long-term deposits. Now, the EBIT to total asset ratio reflects the inflection in the net margin and operating profits. So the return on assets has been steadily around 3.6%, except for a dip to 3.1% in 2016, corresponding to the dip in net margin. Now, the return on equity also shows a range of fluctuations in value. Cost of capital. Knowledge of cost of capital is important since the company must generate higher returns to remain financially viable. But the United Healthcare and Cigna are two major insurance companies in the U.S. Both companies have strong balance sheets and moderate debt to equity ratios. Both companies have substantial retained earnings and therefore have a major internal source for equity. Neither company has issued preferred stock. Now, the cost of capital is therefore the weighted average cost of equity and debt in the company's balance sheet. So the cost of debt is relatively easy to calculate as interest, expense, are specifically reported. The cost of equity can be calculated by two separate methods: the dividend valuation model and capital asset pricing model. The dividend valuation model cannot be applied to Cigna since the company pays out only a small and constant annual dividend, unlike the United Healthcare, which follows the more conventional dividend growth policy. The cost of capital for the United Healthcare group is 8.18% compared to 5.89 or 6.34. For Cigna, depending whether to apply a correction for full year interest costs, companies use a combination of equity and debt finance their operation. Equity financing could be through preference shares or common equity debt financing could be made up of bonds and various length of time at different rate of interest. The cost capital for a company is the weighted average cost of these different sources or finances. The company must use these funds to generate returns higher than the weighted average cost of capital, WACC, to remain viable. So let's look at the cost of capital. United Healthcare, looking back at historical stock prices for the past 5 years, but we're just going to talk about the past 2 years. So December the 31st, 2017, at $223.95, but they traded as high as $223.93, but as low as $220.46. Now, it closed at $220.46. Trading volume was a total of $2,350,200 on the shares. So let's look at Cigna. Now, Cigna opened December the 29th, 2017 at $206. That's what was traded, so that's the high. But the low was $203.05. So at closing, again, $203.09. Trading volume was the total of 7,365 shares. So now let's do a recap. We'll go to a PowerPoint presentation to give you a recap of what I have just discussed. Ratio calculations. So the ratio calculations between Cigna and United Healthcare. Quick ratios is not applicable Cigna Liquidity more comfortable than United Healthcare. Collection period differs, leading to potential higher risk for Cigna. Fixed assets high for both companies. United Healthcare doubly efficient in assets and allocation. Cigna has high liquidity ratios than necessary, high level of receivables in current assets, quick ratios not applicable. United Healthcare is consistent in yearly growth and improvement over 5 years, increased profitability. Cigna, longer collection period, increased risk of defaults, and Cigna's total asset high, resulting in low turnover asset ratio. Capital calculations, United Healthcare. As you can see, net operating capital 2017 was $5,061, and we'll just go all the way down to economic value added was $2,232. Cigna's net operating capital in 2017 was $5,061, and their market value added was $83,752. The cost of capital calculations for United Healthcare long-term was $34,581, and you can see the difference between the two because Cigna was $39,523. So the cost of debt effective, the effective rate for United Healthcare was 3.14%, and Cigna's rate was 0.93. Cost of capital calculations is what we just covered prior. Again, this is just to show you what the high, the low, and the volume and the shares that was received by both companies. Historical analysis of company stock and prices. This just shows us the regression between United Healthcare Group and Cigna. As you can see, the formula is Y equals 6E minus 0.7 X minus 0.0013 R root, square root, equals to 0.0002. And this is just another way of looking at the regressions where I just move the numbers on the left and the right instead of from the top and the bottom to let you get a grand idea of what the regression stock prices look like. Conclusion. Multi-billion-dollar revenues, consistent annual growth, comparable sales ratio. Cigna fluctuates more. United Healthcare sales ratios are higher, better use of assets. ROCE double of United Healthcare. Cigna strong in liquidity, higher risk of default. United Healthcare exhibits stronger financial performance. So the overall conclusion is United Healthcare Group and Cigna are two of the largest healthcare industry companies in the U.S. Both companies have multi-billion-dollar revenues, but are still showing subsequently year-on-year growth. Now, the profitability to sale ratios for the two companies are comparable through Cigna shows significant year-to-year fluctuations. Now, the United Healthcare ratios for profitability to assets are nearly twice the levels earned by Cigna. Since the health insurance industry requires subsequently financial assets, the better utilization of assets gives United Healthcare an advantage over Cigna. The return on capital employed, ROCE, for United Healthcare is consequently at twice the levels of Cigna. Cigna numbers appear much stronger on liquidity. However, its working capital management is poor in comparison to United Healthcare, with over 80 days outstanding compared to below 30 days for United Healthcare. Now, both companies operate with the low debt to equity ratios. Both companies only offer modest dividend payouts and aim to reward investors with the share price appreciation and periodic share repurchase. The analysts suggest that the United Healthcare Group has the stronger financial performance between the two companies, and I do agree. So again, my name is Ingram Mitchum, and this is Finance 652, and I hope you enjoy this presentation.